This is an Uncovered Japan company research report on Keiwa Incorporated, ticker 4251. Keiwa is a small Japanese specialty filmmaker whose light diffusion products sit inside laptops, tablets, and car displays. Its optical business has extraordinary margins and a defensible technology moat, while the stock trades below book value. The tension is concentration. Most profit still depends on one cyclical display niche. The report is dated July 6, 2026. At that point, Keiwa traded on 7.2 times forward earnings and 0.91 times book, with a 4.19% dividend yield. Its optical segment earned a remarkable 48.6% operating margin, and the equity ratio was 76.2%. The valuation is low, but the shareholder base is retail-heavy and margin buying is unusually elevated. Keiwa turns ordinary resin into precision optical components. Opaless diffusion film smooths the light behind an LCD, so viewers do not see bright and dark patches. Newer Opas-Q composite plates are designed for direct-lit mini-LED backlights used in premium displays and increasingly in vehicles. Keiwa estimates more than 50% global share in diffusion film for small and mid-sized LCDs and describes its Opas-Q position as overwhelmingly dominant. The segment split explains both the quality and the risk. Optical products produced 81% of fiscal 2024 sales at a 48.6% operating margin. Functional products supplied 18% of sales at only 5% margin. Optical film is therefore the economic engine. Functional materials in medical, electric vehicle, and industrial applications are promising, but they are not yet large enough to offset a downturn in displays. Keiwa calls its core system SLC times UP, sheeting, laminating, coating, and ultra-precision processing under one roof. Patents, cleanroom methods, and manufacturing recipes developed over decades protect the result. The company also co-develops directly with customer engineers, so qualification and design-in create switching costs. Its niches are valuable enough for Keiwa, but often too small and quality-sensitive for a large materials group to industrialize aggressively. The largest vulnerability is end-market concentration. Notebook computers and tablets account for about 64% of company sales, and the optical segment depends on a small group of display and device makers. That creates strong operating leverage in both directions. Automotive mini-LED displays are the clearest diversification path. Medical dialysis filter film, electric vehicle battery materials, and overseas process paper add options, but each remains small today. Keiwa's financial history is not a smooth compounder. The post-pandemic electronics correction drove a sharp revenue decline in fiscal 2023, and profits followed because the optical business carries high fixed cost leverage. Even after that reset, consolidated margins remained far above ordinary chemical companies. The next phase depends less on simply restoring laptop volumes and more on shifting the mix toward automotive mini-LED products and genuinely scaling a second pillar. The balance sheet gives management time. Keiwa is 76.2% equity funded and carries substantial liquidity. Research and development runs near 8 to 9% of sales, unusually high for a chemicals company, supporting Opas-Q and the Oplam pipeline. Cash generation also supports a dividend policy based on 4% DOE. The key capital allocation test is whether investment converts into a broader earnings base rather than simply enlarging cash reserves. Management's longer-term ambition requires more than a normal display recovery. Automotive mini-LED needs to scale. Oplam optical lamination inquiries must turn into volume programs, and functional product margins must improve. Keiwa is also extending its overseas commercial and logistics footprint. These initiatives make strategic sense, but the report treats them as milestones to verify, not guaranteed growth. The company still needs to prove it can build a second meaningful profit engine. At the report date, Keiwa's forward price-to-earnings ratio was about 7.2 times, and price-to-book was below 1, despite double-digit return on equity and a differentiated franchise. That looks inexpensive beside the peer set. Yet the discount has explanations. Earnings are cyclical, the company is small and thinly covered, individuals own most of the register, and margin buying was heavily imbalanced. Cheapness is evidence, not by itself a catalyst. These are the report author's scenarios, not recommendations or price targets. The downside case reflects another PC demand shock and delayed new products. The base case assumes a gradual automotive mix shift and steady execution. The upside case needs meaningful Opas-Q and Oplam adoption. The range is driven primarily by operating outcomes rather than an optimistic valuation multiple. Investors should therefore watch customer wins, product mix, segment margins, and cash conversion. To conclude, Keiwa combines a genuine process moat, world-leading share, and exceptional optical margins with a conservative balance sheet and low headline valuation. The unresolved issue is concentration. One display niche still produces almost all the profit. The decisive signals are automotive mini LED growth, op-lam volume wins, improving functional product margins, and resilience through the PC cycle. For the full evidence, assumptions, and sources, continue with Uncover Japan's free deep dives. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.